Joining us is Clive McDonnell. He's the head of emerging market equity strategy at StanChart's Bank. Clive, thanks for bearing with us. As you can imagine, it's been quite a difficult day today, given what's happened with Steve Jobs and his death. But I want to just talk to you a little bit about what you've been seeing in terms of equity trading and the fluctuations of volatility that we've seen. Are we any nearer to seeing an end to that?
No, regrettably not. I think the bounce that we're seeing today, follows through from the rally in Wall Street overnight. But what we need to see, and what we've not seen so far, is an effective resolution to the Eurozone crisis. We still have lots of talks and potential packages, but without something concrete on the table, I don't think we can build sustainably into any sort of rally for the market.
Are we going to get anything on this? Do you think that we'll have to wait until the beginning of November, when we have, of course, the meeting in Cannes taking place?
Well, I think that, in contrast to what the UK Chancellor had to say, that, we have 5 weeks to save the euro, I think equity markets could be substantially lower if we have to wait until Cannes for some sort of a resolution. There is a risk, though. Angela Merkel has made it clear that she is not paying any attention to what's happening in equity markets. She's squarely focused on the social implication of what's taking place and how to save the euro. So there is a risk, but I think that of the three options on the table, we are starting to see some serious discussion taking place about which one of these could fly. The reality is, of the three, only one will create the firewall that we need to see between policymakers and equity markets.
I want to just, also concentrate a bit on, if we didn't have the sovereign debt crisis, no doubt the equity markets and many investors would be looking across the Atlantic and looking to the US and looking at the, well, less than impressive growth, to put it mildly, there. What do you make of what's happening in the US? And, we have, of course, Operation Twist in the mix now as well. What does it show? Does it show there's a bankruptcy of ideas, or nothing they can do about what's happening?
Well, I think trying to narrow that big question down, trying to narrow it down to in terms of the implication for Asian equity markets. One of the key variables that we look at in terms of what's going on in the U.S. and what it means for Asian equity markets is simply the U.S. PMI. But more specifically, within the PMI, we look at what new orders are doing and what inventories are doing for the U.S. PMI numbers. Simply put, when that spread is very, very wide, when we have lots of new orders and inventories are quite low, Asian equity markets tend to thrive. The reason is quite straightforward. The inventory pipe is empty, and there's lots of new orders coming through to fill that pipe, and the Asian manufacturers do well. However, at the moment, even from the PMI number that we saw earlier this week, that spread is negative. The inventory pipe is relatively full, and there are hardly any new orders coming through. We still have very, very sluggish new orders in the U.S. economy. As long as that spread remains negative, as it has since June, I think from a fundamental point of view, Asian equity markets are going to continue to struggle. Then we add on the overall liquidity problems in the banking sector, the policy paralysis in the Eurozone, and we do have a combination of a negative economic backdrop for Asian manufacturers, as well as a very difficult policy backdrop as well.
Clive, what does all this mean in terms of your investment strategy? A lot of people I've been talking to in recent days, as you're saying, that they've been shifting or recommending that their clients shift into cash for the time being. Have you been doing the same thing?
No, we wouldn't. Well, our clients, can't hold 50–60% cash. Many have to remain fully invested. 5–6% cash should be the maximum they hold. So with that in mind, keeping in mind that we have to be in Asia, where do we want to be in Asia? I think there is quite an interesting contrast between China and Korea. We are underweight China at the moment, but we're overweight Korea. And one of the reasons why we're overweight Korea is because of the Korean equity market's exposure to China, which has increased dramatically over the past number of years. So on the one hand, that sounds a bit contradictory. We're negative on China, yet we're overweight Korea because of China. But that reflects the divergence between the equity market in China and the performance of the economy. The equity market is facing very, very tough times because of what we know is happening in the banking sector. But overall, the economy, while it's slowed, remains quite robust. And also, we believe in the fourth quarter we could see some sort of an easing of monetary policy. And corporate Korea has exposure to the China economy that's doing quite well, as opposed to the equity market, which is doing quite tough. So we actually favor Korea at the moment relative to China. And that's one of the key recommendations we're making to clients.
Yeah, one is obviously following fundamentals, and the other equity market is not. Thanks a lot for that. Thanks for joining us, Clive McDonnell, there from StanChart's.